Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Friday, April 12th, 5:50 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video. State of the market, we're in a short-term pullback. Last night, when I did the video, much more optimistic about the market. I had in green after short-term pullback. Is it over? The market answered that question today with a resounding no and a big negative expectation breaker, as the term Mike Webster, legend from Investors Business Daily, has coined. And that's certainly what we saw today. Any optimism that we had, even as a team pre-market, while we were looking at a red gap down at the open, we were looking at our favorite names and buying them at support levels, but market just blew right through those support levels, triggered a number of stops, even in things we just bought yesterday. But it's okay to be wrong. It's not okay to stay wrong. Preserve your capital and you live to fight another day. That's what we do here at Revere. Check the trend gauge over here. Neutral on leaders with the red sub arrow. A lot of them had rough days today. Would need to do a deeper dive over the weekend on exactly what survived. NVIDIA is the one that stands out to me as looking fine, but a number of the big seven are still looking great as well. We're going to review the big seven charts because money may flow into them with their solid balance sheets in terms of crisis. But earnings kicked off today, and they did not kick off well, as a leading bank, JP Morgan, took it on the chin, and it trickled over to the rest of the entire market. And that included bad sentiment numbers, and it also included more saber rattling from Iran towards Israel. And the net result is this is a market to tread lightly on. And yes, it can change just that fast in one day. And as we saw from really the beginning of the week through Thursday and now today, going in opposite directions. So on to the trends. Short-term trend, neutral with the red sub arrow. First close back below the 21-day moving average for the NASDAQ 100 and the S&P 500. Second close below will get us on red arrow. We'll see if that happens Monday. Dow, mid caps and small caps already have multiple closes below their 21. 50-day moving average, Dow firmly below that, mid and small back below it. S&P 500 bounced. NASDAQ 100 closed just barely above it. So we're still green there, but with the yellow sub arrow and pointing towards neutral or bearish there as well. Remember, the market, though, doesn't get into serious trouble, and we're talking about bear market type trouble, until it breaks the 200-day moving average, and we're a long way from that. All five of the index is still above the long-term 200-day moving average, so a firm green arrow there. So what happened today? I kind of explained it already. Bottom line is it's a bipolar market, and the bears took charge today, crushing any optimism that the bulls had after yesterday's strong break after 2 o'clock to the upside. Here are the final numbers on the day. The big seven down 1.27%. Apple red, but Apple green, 6 of the 7 finishing red. RG8, not a good day in any way, shape, or form, down 2.2%. S&P 500 gap down 0.7. 3 waves down during the day, a little bit of a bounce into the close, but still down 1.5%. Equal weight down 1.59%. NASDAQ 100 gap down 0.95, closed down 1.6. Equal weight even worse, down 1.87. The Dow down 1.2, mid caps down 1.6, Russell 2000 small caps down 1.9, Global 60/40 down 0.8, as bonds were bid up as part of a fear trade today, meaning yields pulled back. So bonds finishing green sheltered this 60/40 from a really red number, but still down 0.8%. In-house GROTECTION took it on the chin. We bought some things yesterday, got stopped out on them today. did some offensive selling as well with the negative change in character in the market. We'll go through the portfolio charts in a moment. First, we'll go through the inter-asset correlation charts, and we'll show the daily. And in the upper right-hand corner, since it's the end of the week, we're also going to show the weekly. We want to flip back and forth because different stories are told very often between daily and weekly. So here's the S&P 500. You can see the optimistic move up yesterday through the 21-day and 8-day moving average, but lower low relative to the lows of the last 2 weeks, bouncing right at the 50-day moving average. You can see on the 10-week up here, down 1.55% for the week, closing slightly below the 10-week moving average. NASDAQ 100 closing right on its 50-day moving average, just barely below its 10-week, only down 0.5% for the week. You can see the uptick on the weekly and on the daily from a relative strength standpoint. We mentioned that a couple times this week. In fact, bought QLD yesterday, but got stopped on it with the move back below the 21-day. But that is something to pay attention to. If those big seven hold up, it will hold the market up, or at least you won't see losses similar to the way you saw losses in small caps. Dow Jones Industrial Average, waterfallish type stuff here today, down 1.24%, not only closing below the 10-week moving average, but also below the 20-week moving average. That's the green line up here on a weekly chart, down 2.4% on the week. Mid caps, we won't look at the ETF, we'll look at the actual index itself. You can see here closing just a hair below the 50-day moving average and below the 10-week, or the 10-week moving average, down almost 3% on the week. We'll look at the Russell 2000 index here, another close below the 50-day moving average. Rolled over has the 21-day moving average. On the week, down 2.9%, closing right on the 20-week moving average, which is somewhat similar to the 100-day moving average. This is what I'm talking about on how the big seven may bolster the S&P 500 and the NASDAQ 100 from really breaking down the way we've seen the Russell 2000 break down. Onto the VIX. The VIX just with a massive spike today, up nearly 25% at one point, closed up 16% at 1731. So above the 16 level, above all the moving averages. And you can see how the bars on the VIX have expanded this week. And that really is just an indication of volatility and fear. And this Israel-Iran threat, I mean, Iran's been threatening Israel forever, but the government ratcheting up the fear on this, saying it's imminent and all that, really carrying over to the VIX. So we want to be invested when it's down here, when the VIX is down here below 15 and below the moving averages. Tread lightly when it's above the moving averages and above that 16 level. How about the dollar? Dollar is a flight to safety trade. And let's start drawing some lines here. You can see the breakout on Wednesday. Not much of a pullback yesterday, follow through to the upside today. This is a major headwind for stocks. On to precious metals. Big outside negative reversal. These all gapped up in the morning and then sold off. Maybe the baby going out with the bathwater. This has been a very strong trade. People maybe just taking profits into the weekend with uncertainty, but whatever it is, big negative reversal on GLD. NUGT, we closed this out today once when it was extended to the upside, and then with the negative reversal, we closed out the rest of the position for 20-30% gains. Nice trade on this one. But sometimes you just got to book things when markets are not in your favor. I should show GDX. That's actually what the underlying what we make our decisions on, but down 2% on the day, big negative reversal as this has gotten near the top of this big cup base. Silver, huge negative reversal as well, closing down 1.46%. Bitcoin, weak, closing below the 21-day moving average. We sold half of this today, down 5% on the day. For the week, just down 0.7, and really you can see it's in a nice consolidation here on a weekly chart. Okay, on to bonds. Broad bond index, BND. Bonds bid up all day, although they closed near the bottom of the range. This is the broad bond index. On the week, yields up, meaning price is down. So on the week, price down on the broad bond index by 0.67%. TLT is the long bond. Another price spike, but closing at the lows of the day, up 0.5% today, down 1.2% on the week. Again, meaning yields up. TYX, here's the yield on the 30-year, down 1.24% today, but for the week, up 1.54%. And TNX is the 10-year, down today, but up 2.8% on the week. All right, that's the inter-asset correlation charts. Let's go to the tail of the tape. You can pause this. I'll hit the highlights. Flight to safety. Consumer confidence also dropped. Consumer confidence is one thing that really does move markets as well, and the sell-off really kicked in with the negative numbers that came out at 10 a.m. on this. The day count, we've gone up one, down one, up one, down one, back to down one today, below the 80 EMA, below the 21 EMA. Expectations neutral to negative now with that big negative reversal to the downside today. As far as sectors go, besides the dollar and bond prices, ag stocks, the only thing sector I could find that was green, so agriculture commodities, green. 11 out of 11 spider sectors down, led to the downside by semiconductors and biotech. Lots of portfolio changes. Okay, Nugget sold in two tranches. One was offensive selling with the gap up. The other one was defensive selling on the negative reversal. FCX, defensive, well, combination of offensive and defensive. It's extended, it's a leader, it had a negative reversal, so it's kind of a cross between them, but close that position out as well. Dell just plain stopped out on. Same with uranium on the negative reversal. This was strong early, then reversed back down to flat versus our buy, so we closed that out. Same thing with CCJ, negative reversal. SSO, what we added recently, just stopped out on it. Same thing with QLD. And as I said, we trimmed Bitcoin. This is a big move to the downside in our exposure from the equivalent of 1.25% adjusted beta to below market. When I say market, I mean the S&P 500, which is a 1.0. We're down to 0.74 on our portfolio exposure. Bottom line, bipolar market, but the bears crushed Thursday optimism today. NASDAQ 100, S&P 500 barely holding on to their 50-day moving average, but it is not a market where the wind is at our back for certain, and we know from the past to tread lightly in those types of markets. First thing I'm going to do is go through the big seven because there are really some decent charts here. Again, we've got the daily and we've got the weekly. Apple still below the 200-day moving average, but look at the move up the last 2 days on this, and it's up 4% for the week. Money very clearly flowing into Apple, probably as a safety trade. Massive cash on their balance sheet. Did fail into the declining 50-day moving average, but these volume bars and the price action tell me that this has very clearly put in floor below this 170 level. That 170 level also was support going back to late last year while tech stocks were selling off. So there's Apple. Next up, Amazon. Nice week, positive on the week, up 0.57%. Just bounced at the 8-day exponential moving average today after breaking higher. Next up, Microsoft. Treading sideways, relative strength over the last 2 weeks. Great looking weekly chart, down 0.85% on the week. Meta, just consolidating, relative strength, near new highs, down 2.93% on the week. Great looking weekly chart there as well. NVIDIA, 2 days, nice days up, Wednesday and Thursday, with the bounce off the 10-week moving average and closing above the 10-week moving average. Slightly positive on the week, down 2.7% on the day, but below average volume today. And on this pullback, look how light the volume is on the weekly chart these last 3 weeks compared to the massive up volume while it was doing this beautiful ascension since its breakout earlier this year. Google went from the gutter with undercutting and closing the 200-day moving average just 5 weeks ago to new highs. Looks good on the daily and on the weekly, up 3.4% on the week. Bouncing back nicely after that debacle with its AI engine. Netflix down 1% on the day, down 2% on the week, still looks fine on the weekly chart, sitting above the 21-day moving average. That's our big seven. Tesla is technically in what you call the Mag 7, the Magnificent 7, down 2% on the week, but down 2% on the day, but up 3.7% on the week. This declining 50-day moving average has been resistance over the last 7 weeks for it. That's where it ran into today. We'll upgrade it from hot garbage to warm garbage, I guess, but still not something I'm interested in at all. The other stocks that are in the FANG Plus index include AVGO, Broadcom. Nice consolidation above its 21-day moving average, slightly positive on the week. And finally, Snowflake, which completely gave it up on earnings 6 weeks ago, but bounced on the week, up 3.05%, and only down 0.5% today. We've mentioned how some money had been flowing back into software names, namely Datadog, Team, but Snowflake as well. However, it has this declining 21-day moving average acting as resistance. Let's blast through the RG8 right now. And they don't look good. Breaking the 50-day moving average. This is the first one, the Russell 2000 growth. Down 2.8% on the week, down 2.1% today. Breaking the 50, sitting right above the 20-week moving average. LIG, this is the growth half of the small cap 600, breaking the 50-day moving average, sitting on the 20-week, down almost 3% on the week. Mid-cap growth, half of the mid-cap index, down 3% on the week, sitting on the 10-week. QQQJ, breaking the 50-day, breaking the 10-week, down 2.4% on the week. This is a mid-cap NASDAQ 100. PDP, this is a momentum ETF, sitting on the 50-day moving average, right around the 10-week moving average, down 2.4% on the week. SPHB, this is high beta names, breaking the 50-day right above the 20-week, down 2.6% on the week. FFTY, this is the IBD 50 index, down 2.6% today, 3.4% on the week, breaking both the 10-week and the 50-day moving average. And Art K, Kathy Woods, next level, no sell stops, ETF, down 3.5% on the week, but only down on the day, but only down 1.3% on the week. It's below the 10-week and the 20-week, sitting right on the 40-week and above the 200-day moving average. So very weak there. The IBD 50 index, this is just like the FFTY. It's still above the 50-day moving average. Equal weight, NASDAQ 100 broke the 50-day. Equal weight, S&P 500 also broke the 50-day. The FANG S, we keep an eye on this. This is the FANG Plus index. Up 1.3% on the week. In fact, it broke out yesterday. This was another reason for optimism. And relative strength confirmed the breakout. So this had lagged kind of along with the QQQ until recently. The last couple of weeks, relative strength has been in its favor. And then again, here's one last look at the 5 indexes, the S&P 500, the NASDAQ 100, the Dow, mid caps, and small caps. All right, let's go on to the portfolio now and talk about what we sold. I already showed IBIT, showed the QQQ. We trimmed that, showed SSO, CCJ, stopped on this, failed breakout, negative reversal, heavy volume. Uh, Failed breakout is not something you want to deal with, especially in a market that's coming under pressure the way it is. So we just cut our loss on that. And that carried over to the uranium sector as well. Failed breakout. Still looks fine, but the volume was heavy as well. And again, some of these are just market calls, and we don't put up with red in the portfolio when the market is under pressure. Here's Dell closing below the 21-day moving average. Really an ugly move down after that breakout from this cut base, which you can see on the weekly chart, down 11% on the week. Stopped on that as well. Then offensive selling on FCX with the negative reversal, and NUGT, we showed that. So those are all the portfolio changes. We showed the big 7. We actually showed the big 10. We showed the IBD, the RG8. And the next thing I'm going to show is why now's the time. If you've got nice gains, and you should, since the rally in that started back in November, the time to move your assets to Revere is not after the advisor you have them with in a pie chart lets you bleed down 15, 20%. The time to move them is when your assets are at an all-time high or near an all-time high, and you've got an advisor that can protect the downside. We've had a bunch of clients move their stuff to us over the last month. We're hitting this message hard. Like William O'Neill said, anybody can get you in. Who's going to get you out? And I'm not saying my message was slightly different yesterday, as I was very optimistic. But these two columns and these investment approaches don't change between what we do and what traditional advisors do. And we're proud of the work that we put in and the sleep at night factor that we're able to provide for our clients. And if you're interested in this approach, you can reach out. I'm at don@revereasset.com. My partner, Dan Stewart, is at dan@revereasset.com. The phone is 855 Real Wealth. That's 855-732-5932. And with that, I'm going to wrap it up for the week ending April 12th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening, and have a great weekend.